So, a very good evening to all of you. A very warm welcome to another very special session of the Perspectives. As you all are aware that we have recently launched this platform, a platform of learning and sharing, and in different speakers come in and share their perspectives on how do we can grow our business, how we can learn few more things which can help us in terms of our business growth, and also and today is very interesting topic where we are going to talk about in terms of investor management, and not so there no gyan on the investment side, but it is more in terms of how do we manage the behavior. And all of you as partners, they are while you are distributing the products, I think the biggest alpha and the biggest contribution you actually add to all your investors is as a behavioral coach. There are times when investors are really very bullish in the market, and then you really guide them from a behavioral aspect that everything which is in green doesn't need to be that, we need to buy that. And maybe, particularly in the volatile times, you handhold all your investors so that they stay focused on their investment plans, on their goals, and they continue with their entire journey. So your role as a behavioral coach, the more important part in terms of the returns of the investor and the investor experience is driven by how do we manage investors. And today we have a very special speaker, special friend who is going to talk about and share his insights on the investor management, on the behavioral code of how do we, why investors make mistake, and how we can coach them, how we can guide them as Krishna to really help them navigate this entire volatility. So before to welcome Mr. Arun Kumar, Mr. Arun Kumar is the Vice President and Head of Research at Funds India, one of the India's largest wealth management firms with a 15-year track record managing more than 17,000 crores of asset under management. He is the author of the book, The 80-20 Money Makeover, and I'm sure today we will have some insights and some learnings which he has covered in the book also. A very simple and a powerful system to transform your financial future. A must read for all of us. I can recommend that that is coming with a lot of insights and data point which can help you in terms of when you are doing your interaction with your investors. He is widely followed a personal financial finance blogger as well. He is a regular speaker at the various investor and industry events organized by groups such as Tamil Nadu Investor Association, SEBI Investor Education, Council of Financial Planners, Federation of Finance Planners, and many more. He's also a regular contributor to columns in popular business publications and portals such as Live Mint, Economic Times, Business Standard, Forbes, Financial Express, Outlook Money, Money Control, and many more. And he's a regularly shares behavioral science backed investing insights to help us become a better investor. So he is a person who has already written a very famous book, The 80-20 Money Makeover. And in today's session, he's also going to share some of the learnings which he has covered in it, but very importantly, very relevant topic for us in terms of how do you really manage the investors and create, in terms of help our investors achieve the financial goal. So without wasting any time, I would like to invite Mr. Arun Kumar to share his insights with all of us. So over to you, Arun.
Thank you so much, Gaurav. Like, very kind of you, and you've been very generous with your appreciation. So I really hope I'll be able to add some value to all of you present here. And thank you so much. Like, it's a Wednesday, 4:30, and it's not like a weekend. So really happy to see so many of you joining. So I hope I'll be able to add some value. So overall, the idea would be that I'll probably talk for say 40-45 minutes, and then the last 15 minutes we can have some questions. So that's the whole structure. Yeah. Thank you so much. Just a sec. Just the basics. The screen is visible, right? Just a check. Gaurav, is this? Okay, sure.
Absolutely.
Great. So just to start with, the broad idea was very simple. that if you really think about it, a lot of the content or the stuff that we read about is mostly to do with how do you build good portfolio. So if you look at fund managers, or if you look at anybody who comes on the media side, generally I find that almost 95% of what is being solved for is how do you build a good portfolio. But somehow, how do you stick to a good portfolio over a 7-10 year time frame is actually the hardest part. So just like a fitness industry, while there is obviously a lot of fight and debate going on which is the best diet plan, the actual challenge is we're not able to follow a diet plan over a long period of time, which is the real problem. So I think we have a very similar problem in our industry as well, but unfortunately, it gets very it doesn't get enough talking point because it's a very boring subject, at least to talk about. And whoever has talked about it has mostly made it even more boring by saying, hey, humans are biased, this bias is there, that bias is there, but with no real practical implementation possibilities for practitioners like us, right? So mostly whatever I've put together is mostly not done from a very theoretical standpoint. It's effectively what we have tried out with our clients, what we have seen in terms of behavior, where the clients go for a toss, and how do we address that. While obviously I don't know whether I'll be able to cover the whole thing, but at least I'll give you some thought into some of the most important behavioral mistakes that we see. And the good part is that we can mostly preempt them and solve for them. So that's what I'll be taking all of you through in the next probably 40-45 minutes. So broadly, the setup is fairly straightforward. Now, if you really think about it, people, I mean, there are so many hundreds and hundreds of biases, and it's very hard for us to say, hey, today my client is in an overconfidence bias. Tomorrow there is a, I mean, let's say somebody, now it's a recency bias. Now, all these are very theoretical, but how do we actually plug it into our own practice, right? So overall, I've figured out that effectively there are 9 large problems to solve when it comes to behavior, and we find that over a period of time it's almost the same 9 which keep getting repeated again and again. And so I've broadly put it in terms of a simple way to remember is that we call it the triple S trap, which is that the markets, which is effectively the equity markets, are basically trying to do 3 things to you, right? Once you get, let's say you've built a good portfolio for your clients, then the market is effectively market's challenge, or the market's intent is to make sure that your clients are not able to stick to the portfolio over a long period of time. So markets effectively deploy 3 tactics. One, they will try to scare your clients, which is basically they will do something, or there is some patterns that they will put in your clients' minds, so that most often than not they end up selling their equity exposure, either reducing or selling the entire thing a lot earlier than the entire 7-10 year period that you wanted them to hold. So this is the first thing where you are scared out of the market. The second thing that they do, some of the clients are not getting scared, but so the markets, what it will attempt to do is to slow your client, which is effectively every time your clients get some new money in, the market will make it very hard to deploy it, because there it will always feel like the markets are about to fall another 10%, 20%. So this is probably not the right time to invest, and let me wait some more. So the markets, if the market is not able to scare your clients, it will then try to slow your clients. If it is not able to do both, then the third thing that it will do is it will try to seduce your client into going overboard on equities, going overboard on a particular sector, going overboard on a particular fund which is doing extremely well. So broadly putting it together, how does it scare you? I call it the ABCD framework, which is either it will give you an all-time high, it will consistently keep giving you bad news, and then there will always be some expert out there predicting a crash, mostly from the US. And now today we also have a lot of Indian experts also doing this. And the fourth problem is markets will always every year there is always some sort of a decline which is happening, and whenever the decline happens, it always feels like it is the start of a 50%, 60% crash. So this is the 4 techniques which markets will use to scare us, which we will explain. I mean, we will see it in detail in terms of how it happens, what is the pattern, how to identify a lot earlier, and what can we actually do about it. The second thing, as I told you, is the slow you, which is the entry anxiety, that every time you have money, you'll always feel that the market is going down. And I know for sure that all of you would have experienced the same thing with your clients, that every time your client has the money, there's always this tendency that let me wait for some more time before I actually invest. And the third part is the seduce you, where either it will force our clients to go all in. They will say equity is the only place to be. I am going 100% equity. Two, they'll try to borrow and invest. And three is within products, they'll always choose the highest return products. It will be sectors, it will be some small niche concentrated fund which is doing well, or it's generally you go for sectors or concentration or some fund manager whose style is doing extremely well, and hence you build a very very concentrated imbalanced portfolio, and this is called chasing performance. The last thing is derivatives or day trading, and again, like we just got the news 2 days back that almost close to people have almost lost 1 lakh crore, and on average the loss for derivative clients is almost around 1 lakh per client. So again, these are the, so obvious, given the constraint of time, I won't be able to talk a lot on the last part, which is seduce you. So broadly in this presentation, I'll be covering the scare you part and slow you part. So overall, we'll look at these five in terms of what is this pattern, how to identify that, and how to make sure that our clients don't fall for these five patterns, right? So the first thing is, how does the market scare you? This is what I call all-time high worry, and I think probably this will be the next worry point for all of us in terms of our clients, because we are very very close to our previous all-time highs. Maybe the moment Sensex comes close to say 85, 86,000, then you'll again see all the headlines starting that market is again back at all-time high. And generally the tendency is that we remember this quote, right? Buy low, sell high, right? And most of our clients will intuitively try to correlate an all-time high with the fact that markets probably this will lead to the next fall. So one, this can either lead to people taking out the money in the name of profit booking or reducing their equity exposure, or the incremental money that they have, they will not be able to deploy, and they will say, I will wait, I don't want to invest my new money in an all-time high. So this all-time high is a perennial worry, and it will always happen at different points in time. And fortunately or unfortunately for us, probably we are very close to this worry, and I think this is something that will be very interesting for us to talk to our clients before. And one more thing which I have realized is that once the all-time high hits, then it's then it then if you go and talk to our clients, the response is not that great. But if you're able to talk a lot earlier, say when you know that you're almost close to there, and probably if you are ahead of time by probably a few weeks or few months, then the reception is always a lot better. So I think this is probably a great time for all of us to talk to our clients on this all-time high worry. Now, how does that happen? So level one, what is it that we are addressing? That our clients will have the fear that all-time highs will lead to a correction, and hence either they will take out the money or they won't invest new money, right? So one of the ways that we can try to give them some perspective a lot earlier, like today might be a great time to start discussing or send some points on that. Say level one is a very simple perspective that any asset class that grows, it is almost impossible for it to grow without hitting an all-time high. So even a simple FD will have to consistently keep hitting an all-time high. And as you can see, the Sensex, which is kind of started somewhere at 100, and today it is somewhere close to 85,000. It's mathematically impossible that it doesn't hit an all-time high, right? And you can see all the green dots that Sensex will again and again and again will keep hitting this all-time high. And then again, mathematically, if you think about it, most often than not, if somebody asks us what is your expectation from equities, we'll broadly say 12 to 15% returns, which in other words, we are basically saying equity markets will double every 5, 6 years. Now, if we put the same math out, and let's say we're not even, let's say round off that 85,000 to say 80,000, right? Sensex levels. Now at 12, 15%, it essentially means that market should go to 1,60,000 by 5 to 6 years, right? If we are saying that we expect 12 to 15. I mean, we can put any number. You can put 10 to 12 if you think that that's more a conservative estimate. But just a broad sense of how do we communicate this message to our clients. And again, if the same thing happens over 10, 12 years, the markets will have to do 4x. So roughly, we are saying that in a 10, 12 years, if we are expecting 12 to 15% returns, it also means that the Sensex should roughly be close to, should be crossing 3 lakh in the next 10 to 12 years. So if from 85,000, if we have to go to 3 lakh, then it's mathematically impossible that we don't hit all time highs. So at 90,000, again, we'll be at all time highs. At 1 lakh, we'll again be at all time highs. At 2 lakhs, at 3 lakhs, at 4 lakhs. So the whole idea is that in any growing asset class, level one, all time highs are a given. So it is not that all time highs will lead to a fall, but naturally all time highs will have to happen. And you can see that in terms of the number, where for each and every year we put what is the all time high. So if you look at 2019, I think 41,000 was the all-time high, and at that point in time, there was a lot of fear around this 40,000 levels. But right now, given a choice, we would say that it was a no-brainer to actually invest. But at 41,000 levels, that became scary. And then similarly, I remember in 2021, 60,000 was the scary all-time high number. Again, 2023, 70,000. So you can see that every year there is an all-time high which seems very, very high at that level. But another 5 years out, you find that that number was probably a great time to actually invest and not get worried. So level one, we need to start communicating the fact that it is mathematically not possible for this asset class to grow if we do not hit an all-time high. And if you historically look at any of the year, whichever was the all-time high number which was there in that particular year, after 5 years, when you look back at it, it looks like a great time to invest. So there is nothing which is scary or which is good about all-time high. It's just a pure mathematical phenomena, and we need to get comfortable with that. And over the next 10, 20 years, we'll be hitting several all-time highs. So there is no fun in thinking an all-time high to be a scary thing. The second perspective is we also did some number crunching. Like what we did was from the time we had Nifty 50 TRI return, which is almost close to 25-year period, we said for the last 25-year period, if somebody only invested during all-time highs, is it real that if you invest in all-time highs, you make very bad returns? And for our surprise, and which is also correct, because logically we found that all-time highs are a natural thing, right? So we also found that every on an average, the 1 year return that you made was almost 14%, right? If you only invested in all-time highs. And the best part was that almost 60%, you made more than 12% returns. And almost 50% of the times, your next year return was 15%. And almost 77% of the times, your next year, you were after an all time high, the market was actually up. So, which means it was actually positive. So, overall, data is also showing us that all-time highs have nothing to do with a fall. I mean, a fall can happen any point in time, but all-time high is not the reason which is causing the fall. And data also shows that generally all-time highs on average have led to a very, very good next year kind of a return. And the third perspective, and the same thing, that there was also a similar study which was done in US, which also found the same thing, which is that somebody had invested in US markets only in all-time highs, vis-a-vis in all other days. And you found that the returns that somebody got on a 1 year, 3 year, 5 year basis was actually better if you invested only in all-time highs, right? So overall, it is not just an Indian market phenomena. Even globally, all-time highs have generally led to better returns, and it's not something that is should be connected with a market fall. Then the third thing that is very important is that at some points in time, markets tend to get stuck at some all-time high levels, and every time that happens, mentally we get into a pattern that this is that level where every time it hits, it starts falling, and then the brain starts to see patterns. So, for example, 20,000, 21,000 levels was a first time that people got scared by this all-time high. I mean, not the first time, but this was a pattern which repeated. So, because in 2008 it hit, then it fell by 60%. Then again it recovered. Then again it came to that 21,000 dreaded number. Then again it fell 28%. So by the third time it came, I remember in 2013, 14, people got really scared because the last two times it hit that 21,000 level, the fall was 60% and 30%. And now, so most people, I remember, got scared and they took out the money. But what happened post that was, here comes the surprise, that markets were up 80%. Then the same thing happened, whatever happened in 21,000 levels, 20,000 levels, again repeated in that 40,000 levels. So first time it came close to 40,000 in 2018, fell 15%. Then again came to 40,000, then again fell 10%. Then again came to 41,000, then again fell 40%. So by the time this was the COVID fall, and by the time the recovery happened, there was a lot of redemptions, there was a lot of panic that again, will this 41,000, again, this will lead to a fall. But unfortunately, as we saw, it again broke out and it was a 50% gain. So the first time it got stuck at 20,000 and then it broke out, it was almost an 80% upside. Then the second time it got stuck at 40,000 levels, it was again a 50% upside. The same thing happened again between 2021 to 23. Got stuck at that 60,000 levels, 10% fall, again 14%, again 15, again 9%. And then it came and hit that 23, 64,000 levels close to that July 23. And again, what happened after that was again there was a 34% gain, right? So the key thing to remember is that there are times where uh, the all-time highs may be followed by some fall, and then that it might look like the pattern is repeating for 3 or 4 times, which is where it gets very, very dangerous, because the most of our clients will start associating that pattern with the fact that every time it goes to that dreaded level or territory of that whichever band after which it starts to fall, then you start associating that with the fall, and most likely one of the time it will start breaking out, and the breakouts are usually fast, as we saw. It was almost 80% first time, second time 50, and then third time is 40. So you never know what can the breakout be. So overall, putting it, and then the last, so overall the key point is that sometimes it gets stuck at all time highs, but then the key thing to remember is that when it breaks out also, it is a very, very fast and a very, very high gain, that if you take out the money, you can miss out on that. And the fourth thing is, we did one more simple exercise where we again plotted all the all time highs, and we just asked a simple question that if somebody told us that, hey, Arun, I will just wait for 10% correction. So at 85,000, I don't want to invest. Maybe I'll invest at, say, around 78, 77,000 levels. Let it correct 10%. From there, I will invest, because everybody feels that at an all-time high, a 10% correction is a given. So again, we did the same exercise. We put data, and then we asked how many times do you actually get a 10% lower level? While you might always get a 10% correction level, but the 10% may not come from 85. Probably it might come from 1 lakh, or probably it might come from 1 lakh 10,000, which means that I will probably never get the 78,000 level again. And here was a surprising element. 51% of the times you never got a 10% lower level. So if on an average, if you said that I will, every time there is an all-time high, I will not invest money, but I'll wait for a 10% lower level. 50% of the times you never got to invest, because as you can see here, all these red marked zones, right? You can see that after that, if you had waited for a 10% lower level, you never got it. So you can see how the chart this gets visually represented. Like, so the red and green is almost equal. So which means if you're worried about an all-time high and you say that I will invest at a 10% lower level, there's almost a 50% chance that you will never get that level again. And how will you know? Because you will keep waiting for that level. So overall, putting it together, one, it is a mathematical certainty. Two, data proves that on an average you make 14% returns, and on average 77% of the time market goes up after an all-time high. And again, three, it sometimes gets stuck in a pattern, but again it breaks out with a very vociferous rally. And the fourth thing is, historically, if you wait for a 10% gain, 50% of the time you actually never got that 10% lower level. So putting it all together, this is something which is very, very critical, that we keep communicating to our clients, that all-time highs are nothing to be feared. So level one, do not take any decision based on an all-time high. So all-time high does not lead to market crash. It's a very, very common thing that we should all be okay with. So this is the first takeaway. The second problem happens because there's always some bad news. There's always bad news, and every time the bad news happens, it feels that this news is bad, and hence market should fall. And before the market falls, let me take out my money. And moment the news becomes better, then I start to invest back, right? And this is what everybody attempts. But if you really look at it, this is a very telling chart, that historically, if you look at it, there has not been a single 3 month period where there is no problem. There is always, always, always a problem. And recently, think about it. Now we have another war in Israel. Before that, it was India, Pakistan. Then there was the US tariff, and then there was a sell off, then there was yen carry trade unwind, then there is Israel Hamas. So something or the other, then there was election uncertainty. So there is always some bad news, and so if you start uh, getting scared that this bad news, I mean, the bad news may bring the markets down temporarily, but each and every time if you try to extrapolate a bad news, it means that almost every 3 months you will be so imagine if you have a 10-year journey and every 3 months there is at least going to be one or two news. So then multiply 4 into 10, so which is almost 40-50 bad news that you'll have to handle on a 10-year basis. It's mathematical. I mean, it's almost like a certainty that in 10 of that 40-50 bad news you will panic and you will take out the money. So level one, we need to get comfortable with the fact that bad news will throughout be there in the journey, and the same thing happens. It is not a India phenomena. It's again a global. Any equity investor, whether in India or US or any other country, will have to go through that same pain. So this is a chart which we keep sending to our clients each and every time there is, so that you get to step back and say that this is this is how it has always been, and obviously the future will also kind of remain the same. And this is a very interesting chart with BOFA provides, where each and every 2-3 months they ask all the fund managers, global fund manager, what is your biggest worry? So you can see in 2011 it was EU sovereign debt funding, then it was US fiscal cliff, then China hard landing. So all these now look very funny that it really doesn't matter, but when it was happening, it looked like it was the biggest thing at that point in time. So the key point is to give our clients a perspective that each and every time there is a news, you start with these three slides saying that this is how it has always been. So whatever is happening today, whichever is the news is there, it is nothing new. And this news does not mean that we take out the money. So the second takeaway is simple, that there is always going to be bad news, and it is our responsibility to set that expectation right. And the biggest trap that I've seen is that people start extrapolating the news. You try to see what is that news, what will be the impact, and then try to project what the market will happen. I think it's a very, very deadly error, because one, the 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 prediction of the news itself is going to be very difficult because there are so many moving parts. And on top of it, to predict how the markets will react is going to be even difficult. Because I remember in 2016 when there was this US elections, everybody told if Trump came and then if Brexit happened, then it is going to be really bad for the markets. Now Trump came to power, Brexit happened, and then the markets went up. So what happens is sometimes what you predict might also come true. And COVID was also another classic case. When the COVID lockdown started, we were probably sub 500 cases per day, and then in the next 4 or 5 months, it went to 1 lakh cases per day. And this was the first wave. And then by then the markets were already up 40%. Then by the next year, markets were up 100%. But by all of us know, by next year the news was even more bad. So even if you really knew what the news was going to be after a year, the real problem is it's very, very hard to predict how the markets will move, right? So do not attempt, or if you start attempting that, it means every 3 months you are going to try to preempt and predict two bad events, and then most likely you will end up getting out of the markets and have a very bad experience. So I think we have to get comfortable with the fact that there will always, always, always be bad news. But the moment we take the route of I will figure out what this news will lead to, I think it's going to be very, very difficult both for us and for our clients. The third takeaway is some people try to profit from this by giving crash warnings based on that there is this X event happening. And so this event will lead to Y, and hence you guys take out your money. So what happens? I call it the Bahubali. I mean, I call it the Katappa problem, where if you remember the movie, basically Katappa kills Bahubali, and why is because he gets his instruction from his authority, and he is not able to go against his authority or the higher power. And if you look at Indian society, we've kind of been trained from the beginning to respect elders, to listen to what they say, do not talk back, and all that. So as a society, there's a lot of ingrained thing that if somebody who's an expert tells, then most likely it should be right. Then you don't question them. So I think this Katappa effect happens to us because, and this will be the general template which media will use to scare our clients. That is the man who predicted 2008 financial. So the template is simple. This guy who predicted this 2008 crisis is now predicting the next one. You will always find the same template. And the problem is this, that we will say that we don't look at how many times they predicted. The same guy will keep predicting again and again, and at some point in time they will get right. But the media doesn't talk about the number of times they actually got it wrong. So the key thing to remember is that this was US biggest bull market, and you can see at every point in time there was some really, really famous guys. These are not small guys. Jeff Gundlach, Mark Faber, Paul Krugman, and these are like really, really well-known people who were consistently calling for a market crash because they had got successful in the 2008. Again, the same thing had happened. They've been calling for a 2008 crash for almost 5, 6 years. But eventually it came true, and then everybody forgot the previous ones. So somebody got frustrated, called Jay Boorman, and then put all their actual predictions vis-a-vis what happened to the market. So this is a very, very interesting chart. And again, same thing, you can see that at different points in time, this is a chart by White, which again shows that there's always bad news and there's always somebody predicting something bad. And this is a guy who very frequently comes, like this guy is called Jeremy Grantham. Same thing, he has been calling, but the point is this, right? He has always been calling for a bubble. 2010, have cash. 2011, stocks are ranging from unattractive to very unattractive. 2012, 2013 will be dangerous year. 2013, much of everything is brutally overpriced. 14, same thing. 15, same thing. 2020, same thing. Now again, most of these will get circulated to us to because of social media. All of our clients will also get to listen. Then they will ask us saying, if this guy is saying this, should we take out the money? And same thing, he's still continuing in 21. He did it. 23, he did it. And even today also, if you just put Jeremy Grantham, he will be telling something today. So the key thing is to tell our clients that these guys keep telling it because there is no downside to them. But the moment it comes correctly, they will write books, they will become very popular. Same thing has happened for another guy called Robert Kiyosaki. Like throughout the bull market, he has been calling for a crash. Now also he is calling. At some point in time, the moment it comes correct, uh, he will say that I got it right. So the key thing is that always ask that what has been the track record, how long has he been predicting this bubble, right? And mostly you will find the answers to be surprising. Same thing happened for Mark Faber. This is Michael Burry who got a movie made after him because 2008 he came out. I mean he profited from that. But look at that. After that, permanently he's been calling for a bubble, but unfortunately he didn't get it. And you can see that every time you actually listen to him, what is the actual market upside after all his calls. So you can see broadly that uh, once he gave the call of significantly bearish market bet, the market actually went 100% in the next 6 months. So you can broadly see the pattern. Like these are very, very big guys. I'm not saying that we are. I mean, they are not intelligent and all that. It is just that the markets are extremely hard to predict. And the other way to think about it is that if you I mean, are there five people that you can think about who have actually correctly called the top and then correctly taken out the money and then correctly again uh, came at the bottom and then repeated this over 3 or 4 different market crashes? It is, I mean, if there was somebody, obviously all of us will know, right? So while a lot of people will keep attempting, and these are very, very intelligent, very, very smart, very, very high, I mean, very, very high net worth guys. But the whole point is that market will end up humbling all of us. So the market is very, very difficult to predict. And so we will need to come to terms with that. And this was again like Raghuram Rajan calling for a crash in August 2014. But all of us know what happened after that. At that point, name Sensex was at 25,000 levels. And then all of us know what happened post that. So there was also a JP Morgan guy who got frustrated by all these calls. Then he said, I will take all the big guys. And I assumed that every time they gave the call, I moved my money from equity into cash. And what was the actual results? So you can see how S&P 500 uh, broadly became 3x. And then if you had followed any of these guys and taken out your money, this is what happened to your portfolio, right? So this is again a very interesting way to look at what happens if you follow these guys. So I mean, this is a video which I think in the paucity of time I won't be able to show. But again, you can Google saying that Udayan Mukherjee uh, honest confession, basically where he says that after all these years of interviewing people asking what can happen, he basically says that it's almost impossible for anybody to know what will happen to the markets in the shorter run. So don't waste your time doing that. It's a very interesting video. So maybe if you can hear this, it will be fine.
think we can't hear it.
You can't hear it?
Mhm. No.
Okay, fine. So I think maybe we'll skip it for now. But you can Google it. It's a very interesting 2-3 minute video where essentially he says that though I mean basically here is somebody who's interviewed almost all the big guys asking for their market view. It's a very honest confession where he says that nobody knows, and so there's no point trying to predict the markets. But over long periods of time, it's all that matters is your profits and your valuation. That's it, right? So it's a very interesting video that so overall, the key takeaway for us is that so level one, markets will try to put all-time highs, confuse our clients. Two, it will give bad news. Three, there will be some guy out there calling for a market crash, and it is our responsibility to make sure that we just ask the other question that are there five guys who have done it, and if they have done it, why do we not know them? And key thing is what is the track record of their calls? Like if is he somebody who's always calling for a bubble, and most likely they will fall into that pattern. And the fourth mistake that we do is there's always a 5 to 20% kind of a correction that happens. And then the problem with 5 to 20% correction is that it will always look like the start of a 50% fall. So if you look at it, this is a 45-year data that we had for what is the kind of falls that we should be expecting on a year on year basis, which is within the year. What was the intra year from the maximum point to the bottom most? How much was the fall? You can the first thing that you'll notice is that every year had a fall. There's not a single year where there has not been a fall, right? And then you can see that the falls have generally been around 10 to 20%. So there is only 4 years, and out of which 2023 was one where the fall was lesser than 10%, because otherwise mostly you end up with falls which are in the range of close to around 10 to 20%. So the key thing to remember is that each and every year there will be a fall, and every time there is a 10-20% fall, you will always feel that this is the start of a 50-60% correction. But the here is the good part. While intra year, every year you have a fall, by the end of the year, 3 out of 4 times the year, almost 80% of the times, you end up with a positive year, right? So, which means most of these falls will be very temporary. COVID was a classic case. Markets went down 40%, but by the end of the year 2020, the markets were up 16%. So, most often than not, you will find this pattern that there will be a 10-20% fall every year, but more often than not, in fact 80% of the times, the market tends to recover within the year and end the year with a positive outcome. So just one second. This is the same chart. Like you can see the calendar year returns. Mostly it is green, but you can see the intra-year drawdown, which is in red. And 2005 was a classic case where intra-year, or sorry, 2006 was a classic case where within the year you fell 30%, but again by the end of the year you are actually up 47%. So which means if somebody just slept off from the beginning, you ended up making almost 50% returns, but in the middle you had to go through a 30% decline. And this is a common pattern. This you see it almost in every year. So the key thing to remember is that 10-20% falls are a part of the expectation. So every time you have 100 rupees in equities, always assume that as long as it is above 80 rupees, it is fine. So if you have a 1 crore portfolio in equities, so by default, we should say to clients that every year mentally demarcate it to 80 lakhs. As long as it is above 80 lakhs, it is doing fine. And that 1 crore portfolio coming to 80 lakhs should be a part of the basic expectation, because that is what the last 45 years have told us. And even if it is a bull market, there will be a lot of these 10-20% corrections. So this is a bull market between 2000 and 2007. Again, you saw almost six corrections. Same thing happened 2008 to 2020. Again, we had a lot of corrections. And once in a while, it also has a very large correction. But the good part is that it's a very rare thing. 2008 was one. Before that, 2001. 2020 was very sharp. Like within 4 or 5 months, we were back to square one. But this long drawn, painful, long corrections, that is a very, so in the last 25 years, we've had only two. So which means roughly every 7-10 years, it's a good enough expectation to have that there will be a large 40, 50, 60% fall. But again, the key point is that it's not a yearly thing. It is probably once a 7-10 year kind of an event. So over a 20, 30, 40 year cycle, you should expect probably 3 or 4 or probably 3 to 5 large falls. So which is again, so every year 10 to 20% should be a part of the fall. So which means you can say that as long as you follow the 80% rule, which is your portfolio doesn't come below 80%, this is normal. And then once in a while, once every 7, 10 years, you will have a larger fall. But the good part is that even despite the larger falls, the market continues to go up. And over a long period of time, the market returns have kind of mirrored what was the underlying earnings growth. And roughly, you can see that Sensex, despite all these falls, have delivered close to 14%, which is roughly 148 times in close to 39 plus years, right? So again, 10-20% falls super common as your birthday. So there's nothing to worry about this, right? And so putting it all together, there are four reasons to get worried, right? One is all-time high, two is bad news, three is somebody calling for a crash, and four is market actually declining by say 5, 10, 15% kind of a number, right? Now the key point as we discussed is do not worry about this. But again, if we say that do not worry about this, at some point in time, as I told you, there might also be that 50-60% correction happening, right? So if we start becoming too complacent, while we'll be okay for 90% of the times, there'll be the 10% of the times where we will actually need to be worried. But the key point is that this all-time high or bad news or crash warning or decline is not the reason to get worried. The real reason where you will get worried is when we get into a bubble phase. Now, this is a way in which I kind of like to see the markets, where the blue line is broadly the earnings growth. Now, broadly, the markets will revolve around the earnings growth, given that valuations are a lot more sensitive to flows and sentiments. The valuations, as they move up and down over the earnings growth, the dotted line is where the market looks like. It is always volatile, but broadly it will follow the earnings. The reason when you should actually get worried is when you get into a bubble phase, right? Where your market has gone so ahead of earnings, and the valuations are so high, and the sentiments are so high, and the earnings growth is also at the late cycle. So this is where you start to worry. So the key point is don't worry about A, B, C, D when it normally happens. But in a bubble phase, irrespective of whether you get A, B, C, D or not, this is where you need to worry. Now, how do I figure out where we are in the cycle? Broadly, there is a bear market, there's a bubble market, and there's a bull or a boring market. Bull markets are easy. You participate, you make a lot of money. Bear market, when it is down more than 20-25%, you get into a bear market. Again, it's painful, but if you're able to invest more, you make a lot of money. Bubble is where you need to get very, very careful. So how do we identify whether we are in a bear market? Is simple. Anything more than 25% fall is a bear. So this is eliminated. This we can easily identify. But the real problem is we always keep confusing between bubble and bull. So in the last 5-6 years bull market, it always felt like we were in a bubble, and people will always be calling for a bubble. So unless and until you have a framework to identify where you are in the cycle, whether you are in a bubble or a bull market, you will tend to confuse both and then lead to either coming out of the market or getting too complacent, where in a bubble you assume that it's a bull and then you become very, very complacent and you take much higher risk. So how do we do it? We have a framework where we don't look at one indicator, but broadly we look at 5-6 indicators together, very similar to how five blind men touch the elephant at different points in time, and then they identify it to be something else. But however, if we get all these different perspectives, put them together, then we are able to connect the dots and see the whole elephant. So how do we see the whole elephant? We look at five blind men framework to identify a bubble. Look at five things: where we are in the valuation cycle, two, where we are in the profit cycle, where we are in the demand and supply, where we are in the sentiment, and what happens to the triggers, right? So broadly, when in a bubble, valuations become very, very expensive. You measure it through P, PB, and then you compare earnings yield to bond yields. You look market cap to GDP. And then again, sorry, I think I've just interchanged the valuation metrics and the profit cycle metrics. You can assume that the value meter and BAF models come under the valuation, and the profit cycle, the other things come under the profit cycle. My bad, sorry. So the profit cycle, broadly, we look at the ROE, we look at the PAT to GDP, we look at the corporate balance sheets, we look at the credit cycle, CapEx cycle to see whether we are in early cycle, mid cycle, or late cycle. So usually high valuations, late cycle of profit growth, and then demand and supply, both FIIs and DIIs, if they become very, very positive and very, very high flows, then we get worried. And then again, supply also comes in, lot of IPO selling, lot of promoters selling. So generally, when that all three happen, we get worried. Then the blind man 4 is sentiments also get crazy. Lot of small cap exposure. Sentiment indicator goes crazy. VIX goes very, very low. Then there is a parabolic up move in the last leg of a bubble market. A lot of sector funds a lot of NFOs get launched, a lot of new investors get added. And then the last point is if all these four are very negative, and then we also need a trigger. The trigger usually comes in terms of leverage. Either banks are over leveraged, corporates are over leveraged, government is over leveraged, or households. Then there'll be some political uncertainty, or there is some unpredictable crisis, which again, obviously, we can't predict it. But usually, the fourth trigger is weak macro. So generally, weak macro, leverage, and political instability is something that we can evaluate on. So broadly, if you put all these five together, you will get a rough sense of are you in a bubble or not. And generally, in a bubble, most of these indicators will get a negative, right? So this is how we see if we are in a bubble. And generally, when we are in a bubble, we tend to become negative. So what we do at Funds India is we publish this on a month-on-month basis. So overall, the way we do it is, hey, every time there is a concern on all-time highs, bad news, some crash warnings or some declines, we will say the probability of this becoming a 50-60% correction is only high when you are in a bubble. Now, based on our framework, we are not in a bubble. So you don't need to worry about them. But at some point in time, when we get into a bubble, we'll say today anything can become a trigger. So the same all-time high we need to worry, the same bad news we need to worry, the same crash warning can come true, the same decline can lead to a larger decline. So the key starting point for us is because we added this bubble market framework, life became a lot more easier for us, both in terms of communicating to clients and for also us to have the confidence that we are not getting too complacent. So this is how we try to address this whole idea about how do you make the markets not scare us and our clients. The last thing that the market does is it also tries to slow you, and this I'm sure all of you would have experienced that every time there is every time there is a new money to be invested, we will always feel, we and our clients will always feel that let me wait for a 10% correction. So this is an important quote by Peter Lynch, which says that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the actual correction, which is like a very, very profound thing. And so the question is, this question looks logical, but we also ask some basic data crunching on this. And we said, hey, for waiting for a 10% fall looks fine because almost every year you get a 10-20% fall. So doesn't it make sense? But here is the crux. The 10-20% fall every year does not mean that from today's level we get it. Probably it comes after 10% higher levels or probably after 20% higher levels. So when we did the math, we found that almost 45% of the times in Sensex, you never got a 10% lower level. So which means every time you take the decision to invest at a 10% lower index level, you probably never got that, right? So this is the first shocking thing. And the second thing is, if you are waiting for a 10% correction and the market moves up, say another 10-20%, and at 20% higher level, it's no more the same 10%. Then you need the markets to correct almost by 25% to get back those levels. So every time the market goes up against your view of market fall, then each and every time the fall required is much, much higher. So overall, the odds keep going down and down as the market goes against your view. So it is very, very dangerous. 45% of the times you never get that. And two, if the market goes up, then the fall required is no more 10%. Probably it becomes 25% or 30%. And then again, we ask the question, how much do you actually miss out? And on average, in the next 1 or 2 years, you ended up missing 30 to 60%. And then there's only a 50 to 60% of the times you never got that correction within the next 1-2 years. So which means most often than not, how long do you wait? Right? You can't wait indefinitely, right? After 4 years, if there is a large correction. But for 4 years, who can wait with that money, right? So generally, most of us at max might wait for 1-2 years. So in that level, the odds are even more lesser because almost 50 to 60% of the times you never got a 10% correction within the next 1 to 2 years. And the fourth part is become very, very behaviorally challenging because one, you have to accept you're wrong. If you say that I will wait for a fall and then the market goes up to invest, right? Then it means you are accepting you're wrong. And then you capture a permanent loss because people forget that you can also lose money on the upside. Because let's say if I have 10 lakh portfolio and then the market goes up by 10%, then the 10 lakh becomes 11 lakhs. But now I have not invested and I'm waiting. Now I decide to invest. So this 1 lakh which I've lost, will permanently keep compounding. So at 12%, you're almost looking at 10x over 20 years. So which means this 1 lakh which I've lost because I did not invest will permanently keep compounding. So which means over a 20-year cycle, I've lost 10 lakhs. Then over a 30-year cycle, it becomes even more. It's almost becomes 30 lakhs. So which means each and every time you try to time the market by waiting, and whatever is the upside that you miss. Unfortunately, this does not get captured in the client reports or any of the fact sheet, but each and every one of the upside that you keep missing also tends to compound. So over a long period of time, if you keep doing it, you end up missing a lot of it. Right. So overall, why is this decision difficult? I'll just take like 3 minutes and then we should be done. Why is this done? Because one, the question is, even if the market falls, right, then the question is, should you invest all at once or in smaller portions? Then at what percentage will you invest? Will you invest at 10%? Because at 10%, you'll feel that it will go to 20. Then what if you invest everything at 20 and or at 10 and then it goes to 20 or 30 or 40? And then what if you are waiting for 10, then it goes to 8 and then again recovers? Then if it goes up, right, from the time you said that it'll go down and it goes up, how long will you wait? And how do you know, like, how do you know if waiting was the right decision, right? And what if the market never falls? Because at 20% up, you need a 30%, I mean, you need a 25% fall, right? And will you be comfortable, right? Because as I told, behaviorally, it's very, very hard. So overall, what we found was generally when again we did the math, we found that for the last 25 years, generally lump sum works better than staggering. And this is another mistake which I've seen a lot of advisors doing, where you stagger it over 12 months, 18 months, 24 months, 36 months, because it feels comfortable. But the odds are against you if you do that. So generally lump sum works better. But again, as we know, lump sum is very, very behaviorally difficult. So the idea is, can we do a mix of lump sum and STP over 3 or 6 months? And generally, we found that 3 months to 6 months seems to be the sweet spot. The more you go beyond that, the odds are against you, because generally at 3 to 6 months, the odds of lump sum working better by more than 5% is 30%. The odds of SIP working better by more than 5% is almost 19%. So it's not, and mostly whether you're lump sum or SIP, the entry price difference is only plus or minus 5%. 50% of the times, it's not like a very big killer for you. But as you go down the path of extending your time frames and staggering it over longer periods, it becomes more and more dangerous, because lump sum does better a lot more times, and you will inevitably end up losing a lot of the performance due to unnecessarily extending it to us. So, in our view, the general sweet spot is lump sum plus an STP period of 3 to 6 months. Generally, we do 3 months, but if you're too worried, then probably 6 months. And the same outcome or the same conclusion has also been got by Vanguard, who did the same exercise for different markets. They did it for US, UK, Canada, Europe, Australia, and different countries. And they found almost 65 to 70% of the times a lump sum beats the staggering or the STP kind of a method. So overall, what we do at Funds India is that we have, instead of making this a very very haphazard ad hoc decision, we publish something called the value meter. I mean, forget the spelling; it's actually there is an e coming. But the broad idea is that the value meter tells that how expensive are we? Are we close to 100 or are we close to zero? 100 meaning very expensive, close to zero meaning very cheap. So generally, what we do based on the value meter, we will split it into a 3 to 6 month STP and remaining into lump sum. So let's say today value meter for us is 66. So what we will currently, so today, sorry, it's at 63 and this month is 66. It just came yesterday. So what we will do is this 60% will go via a 3 month STP, and the remaining 40% will go via a lump sum. And similarly, if this number crosses 70 where it becomes expensive, we'll do the same logic. Probably 70% goes via STP, the remaining 30% lump sum, but the same STP will convert it into a 6 month STP. So based on valuation framework, we are able to decide the mix of how much goes as immediate lump sum and how much goes as staggering. And this is something that you can also do, whether if you're not able to do something like this. There's a lot of BAF models which you can use. Probably Robeco also has a BAF, and you can use their equity valuations as a proxy for this, and then say whatever is the BAF's equity allocation, I'll do lump sum. The remaining, I'll either do a 3 month or a 6 month STP. So overall, investing immediately works better. statistically, but behaviorally staggering and lump sum works as a better approach for our clients. So overall, putting it together, the markets will try to scare you using all-time high, bad news, crash predictions, declines, and there will always be entry anxiety. So the way to address the scare you part is to build a bubble market framework, and the way to address the slow you part is to build a lump sum deployment framework, which can be based on valuations. And the BAF models can be a good proxy if you're not able to build something on your own. So these are two broad things which I wanted to share. And on the bubble market framework, what we use is valuations, earning cycle, flow and supply, sentiment, and triggers. And similarly, lump sum deployment, we base it based on valuation. So that's broadly what I wanted to cover. And apart from that, yeah, like as Gaurav told, I've also published a book last year. It's been doing really well, and there's been a lot of people who have been very very kind, especially from the advisor community who have. I mean, this was one where Uday Doot had shared it as one of the must read books in the top 4 books that he loves. And then again, this is Gautam Bazan, who's also a close friend of mine. So he had also mentioned it, and in a particular podcast, saying that this is one of the best books for advisors. So yeah, so I've got a lot of decent feedback. So if you broadly like this, if you like what you listen to, the book has a lot more details in terms of it covers the entire framework on how do you build portfolios, how do you build the behavior part, and how do you do the savings part, so that overall it gives you a structure in terms of how can you build and manage build good portfolios and manage client behavior, so that overall the experience is good. And yeah, and if you want to get in touch with me, I'm very active on Twitter, LinkedIn, and there is also a blog that we kind of write. So yeah, so that's broadly what I wanted to share for today. Yeah, thanks a lot for the time, and I hope I was able to add some value. Yeah, Gaurav, all
Very big thank you, Arun. Very, very insightful presentation, very powerful data points. And I think clearly you are one of those people who are making point with proper history and data points so that it becomes very, very effective, I think, but very valuable insights. Thank you very much. So with that, thank you very much, everyone, for your time. Thank you once again, Arun, for your time. Many, many thanks to you. Thank you.
Thanks, Gaurav, and thank you everyone for joining. Yeah, thanks. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.